Welcome to Opal's TV. Today I'm in Tokyo together with John Trammell. John is the managing director of Symphony Financial Partners. So we are in Japan, and Japan has actually been a value trap for investors for many years. But what is happening recently is that the fundamental changes are actually finding traction. And this is also reflected in the year-to-date returns of Symphony, which as of October 2019 is up over 20%. But for Symphony, this is not just a recent phenomenon, because since inception in 2003, the fund has actually been compounding in the mid-teens. So John, tell us a bit about your story. How did you get started in Japan, and what's the opportunity set for investors right now?
So I went to Japan in the late 1970s at Waseda University, and I also helped to write a couple of books on Japan in the years after that. I discovered David Barron and Kazuhiko Shibata several years later and became an investor in Symphony. Many years ago, David asked me to join, and I did. And that's sort of how I got from Richmond, Indiana, through Tokyo into Symphony Financial Partners. So Matthias, 95% of the meetings that I have with institutional investors start out with them saying that for nearly 20 years they've had no exposure in Japan, that they currently have zero exposure to Japan, and why would they have any exposure now? And I briefly began to tell them that there are several changes happening in Japan which are going to allow for the full realization of that value that they have been missing for 20 years. So beginning in 2014 with the release of the Stewardship Code, and again in 2015 with the release of the Governance Code, the government began pushing for companies to begin to release the amounts of cash that they had on the corporate balance sheet. When they didn't move quickly enough, the codes were revised and re-released in 2017. And if you read carefully between the lines, what the Stewardship and Governance Code are saying to people is, okay, you slayed the savings dragon. You did a better job at savings than almost anyone could. Now we need you to slay the investment dragon. We need you to put this money to work because we need the returns. Your pensions have been combined into GPIF, one of the largest pension funds in the world at nearly $1.4 trillion. There are 3,700 listed companies, publicly listed companies in Japan. It collectively, on their balance sheets in cash, is almost $4.5 trillion in cash. So we're not going to talk about the retail level today, but at the retail level, there are probably another 15 to 20 trillion dollars, US dollars, trillion in cash stuffed in mattresses and in shoeboxes in Japan. But let's return just to the corporate balance sheets for a minute. So I could give you a list of over 400 companies that have a net negative enterprise value. That's difficult for most investors to understand. That means that there's more cash on the balance sheets of these companies than their stock market price would be. So what we're trying to do, what the government is trying to do, is get some of that cash to work because they need the returns. So not only is there the push from the government, but there are other reasons, there are other steps in the stool. The second leg would be is that JPX, that owns the Tokyo Stock Exchange and the Osaka Stock Exchange, is going to change the listing requirements of the companies in Japan. So on the TOPEX first section, there are nearly 2,100 companies, ranging in value from nearly 25 million in market cap to, let's call it 10 billion in market cap. But 90% of those companies, both in the TOPEX first section and the 3,700 that I mentioned, have a market value of less than $2 billion. So it is a small and mid-cap market almost entirely. It is not the Japan that most people pay attention to. This is not a growth story. It's not a disinflation story. It's really about changing the fundamentals of the way that the stock market operates in Japan to realize the value of these companies and to get that cash to work. So let's talk about the Tokyo Stock Exchange or the equity market in Japan. The equity market in Japan was never about price discovery or access to capital. It was a prestigious thing to have a listing. It helped you attract a better kind of employee, and it also helped you retain those employees. If there were a market for corporate control in Japan, the way there is here, where you could, or in the United States, where you could buy 51% of a company on day one, then there would be a decades-long feeding frenzy of levered recaps and private equity happening in Japan. But because of the liquidity constraints and the size of the majority of the companies, you can't do that. So what the Tokyo Stock Exchange is going to do is they're going to say, look, if you want to remain listed in the TOPEX first section, you have to have a market cap of, say, 300 million. We don't know exactly what the number is going to be, but let's say 300 million. And you also have to have a number of days of liquidity with the float so that there's actual liquidity in your equity. And you also have to do all of your reporting in English because we want to encourage, the Japanese want to encourage international investors into Japan. So that combination of things happening to the stocks in the TOPEX first section are going to force a whole lot of rethinking of Japanese company management. Why are we listed? Why do we want to remain listed? Maybe we should take ourselves private. Well, for our employees and our groups and everything, we want to remain in the TOPEX first section, which means we better hurry up and merge with some other companies in Japan. So those actions alone, between the government push as well as the Tokyo Stock Exchange, are going to cause there to be a wave of acquisitions and mergers and MBOs in Japan. There's a third leg to this. It is not just the Tokyo Stock Exchange and the bureaucrats that are pushing for this. MEDI, the Ministry of Economics, Trade, and Industry, is also pushing and helping to do this. So they have just recently issued in June of this year new codes for fair valuation of companies, basically giving people a playbook by which they can do mergers and acquisitions. On top of that, they have just recently, less than a month ago, changed the tax codes. In the past, when you acquired a company, the acquired company was forced to sell those shares when you did share-on-share buyouts immediately and pay the taxes. This was a huge tax burden and kept many people from wanting to be acquired. In the changing of the rules, they've now said you can hold the acquiree's stock as long as you want and then sell it when you're ready and can pay the taxes. So this is a huge change. All of this is an encouraging mergers, arbitrage. So that's why you see so many investors like KKR and Carlyle and Cerberus all raising Japan private equity funds because they see this same opportunity and want to try and participate. Symphony Financial Partners is actually delighted that they're raising these monies because it will give us another strategic seller, for us as a seller, another strategic to sell to. So that's the basic story of what is happening in Japan today. Many of those cheap stocks that we talked about are going to have to realize the value of their equity either through management buyouts or acquisitions or mergers with other companies.
So John, this is surely a highly attractive outlook, right, for your company and many others who will maybe going back to Japan. But on the other side, you also made quite decent or excellent returns, right, over the last few years. So explain to us your current investment approach and then also what you expect specifically to happen in your strategy going forward.
So Symphony has always been among the very best value trap escape artists in Japan. They have a whole process honed around engagement with the companies, getting management to agree, and also having always worked on the exit strategies long before they acquired the stakes. So one of the things that's happening in Japan now is the result of the things I was talking about earlier, is that more companies are coming to us and saying, we understand you have a playbook for how to do this, and we'd like to get on board with the stewardship code and the governance code. So The opportunity set is opening up. The other thing is that in 2019, this year, for the first time, we've had inbound buyers call us and say, hey, we can see that you own 20% of XYZ company. Could you introduce us, or would you consider talking to us about a sale? That's never happened to us before, both the inbound from the Japanese companies and sort of the inbound from other investors who are interested. We own most of our portfolio is owned over 5% of the company that we're targeting. We have a very concentrated portfolio, 10 to 12 stocks, and most of our acquisitions, or I should say investments, are public record. Anybody with a Bloomberg machine can see most of our portfolio. So it's not difficult to see which companies we're betting on and which industries, that kind of thing. So the inbound isn't a surprise to us, because as more people become interested in the values, and you have to remember that we don't buy anything where the management is not already on board for what we're going to do. We're not activist, we're not hostile. It's very much more of an engagement process. Managements come to us because they know we're not going to put their name in the press. We're not going to start some sort of hostile action, and we're going to help them achieve whatever their goals are, whether that's a management buyout or a sale to a strategic so they can increase their distribution for higher growth. Those are the kinds of opportunities that we look for. And the private equity people who are raising money are very interested, because we never pay more than 5 times EBITDA for any of the companies that are in our portfolio. So that makes many of our portfolio companies very interesting to private equity companies. We act very much like a private equity investor in public equities, but we don't put ourselves on the board. We don't tell the company how to do. We only buy excellent operating businesses, and there's the opportunity. We're able to buy excellent operating businesses that want to realize the value of their underlying equity. So let me share some further details about why this opportunity is compelling. We're talking about small and mid-cap Japan. So valuations themselves are very compelling, and corporate profits in that group are at an all-time high. Yet sell-side coverage is at a minimum. So you're talking about a group of largely unfollowed, undiscovered stocks that can have their value realized in a way that has not been able to be realized in the past few decades. You have to remember that, contrary to American and even European culture to some degree, Japanese companies don't recognize shareholders as being anywhere near the top of the pyramid. In fact, they're almost always at the bottom of the pyramid. It's ironic to us that as Jamie Dimon and others in America are talking about maybe companies shouldn't be run for the benefit of shareholders only, there isn't a company in Japan that has ever been run for the benefit of shareholders first. So it is a transition. Maybe it's happening globally, but there is a transition in Japan that maybe we should pay more attention to our shareholders, because traditionally it was the employees, customers, then the board, maybe shareholders. I could introduce you to dozens of companies in Japan who've never talked to their shareholders. So it is a transition that they're beginning to recognize as a part of this stewardship code and governance code, that they need to have better communication, more transparency, protection of minority shareholders' rights, all a part of this changing corporate culture in Japan, to realize the value of the cash that they have saved for the last decades.
John, I'm wondering, with all these changes that are going on the stock market, corporate governance, etc., is this a project that's actually coming top down from some of, let's call it, bureaucrats? Or do you see that the whole Japanese society is actually behind that and pushing for it?
So traditionally, well, let me start by saying, yes, there is a societal push to get this done. It's not just Abe. It's much deeper than Abe. It's much more sustainable than Abe. So let's start for a second and talk about demographics, which is one of the negatives people bring up all the time about Japan, that it's depopulating and that they won't be able to find enough workers. So they've done a couple of very interesting things. Abe gets a lot of the credit for encouraging more women in the workforce to come into work. There's also they don't like to talk about immigration. So what they did is they fixed it with a visa policy. So now you're able to get a 7-year visa, which can be renewed for another 7 years. So a 14-year visa is a pretty solid answer to an immigration policy. So there's that. There's also the fact that because of the demographic situation that you have, it's often easier to find engineers in another company than it is within Japan to hire yourself. So let me tell you what I mean is that if you acquire 20 or 25% of a company, not a wholesale merger, just 20 or 25% of the company, you get equity-like accounting. In other words, you can take the earnings from the 25% of the company that you own and drag them straight up to your earnings line. So it's a very auspicious way of finding growth without having to mingle your corporate cultures. But this also gives you access to those 6 engineers that you need, because now you can send the project downline to your subsidiary and you'll get the work done that you need to get done. So this is another very interesting trend in Japan to pay attention to. Another aspect of this generational change that certainly isn't lost on anyone in Japan, but is maybe news to people outside of Japan, is as the population ages and there is generational turnover in the corporate management. I'll give you a perfect example. We've talked to a company in Japan for over 8 years. We laugh about it sometimes. Many hedge funds will tell you that they see 600 companies or have 800 meetings a year. We probably have 600 meetings a year, but it's with the same 15 companies. So we've been talking to this particular company for 8 years, and it has a product that has become certainly much more popular in the last few years after Fukushima and the tsunamis that have hit, the flooding and some of the earthquakes. It's a household product that has suddenly captured the imagination of many people in Japan, and so the growth of this company has picked up significantly. We hadn't even approached them, although we've talked to them over the 8 years. They approached us because there was a generational change within the management, and they were now ready to try and take a new tack towards either a management buyout or a strategic sale. And this is happening all across Japan. And we just think it's another leg, I guess, if you will, of the stool in the story for what is going to make Japan a real surprise for people over the next decade.
How do you pick your investments? How do you select the companies you are investing in?
Well, as you would suspect, after 17 years of operating, we have very strict, thorough, and repeatable processes. So we have an entire grid of companies that we're looking at constantly. And remember, we know the managements extremely well because we're meeting with them all the time. I think it's important to remember that David Barron and Kazuhiko Shibata, who is Japanese, both of them have been in Japan, certainly Shibata, but also David, for more than 30 years. They've been together as a team for more than 20 years. So certainly there is an expertise and a deep level of understanding small corporate and mid-sized corporate Japan and at a rare level. And I also think that our 9 analysts in Japan that see the companies and work with Shibata and David to see the companies and organize the portfolio have been doing this. Our lead analyst has been with us 14 years. Most of the senior people on the team have been with us 15, 16 years. So it is a well battle-hardened team of people who are used to looking at companies. And I think I mentioned to you about Japanese companies coming to us this year and asking us about the playbook. It's because they consider Symphony to be a safe Japanese pair of hands with whom to deal, not outside activists, gaijin coming in to try and take their money. And I think it's an important difference on the way that companies will allow us to approach them. Then you take our own process, which is saying we don't want to buy just cheap. We can give you list after list of cheap companies. They have to be cheap, but they also have to make good products, have a high degree of market share, and these are the kinds of companies that then we want to be able to communicate with the management to take them through the process. We actually think of ourselves as a group of people who would own 100% of any of the companies that we approach. Ideally, we'd like to have between 20 and 25% because of the things I mentioned earlier about accounting make that block look more interesting to an acquirer. But we really think of ourselves as buying 100% of the business. The business has to be that good that A, we could explain it to our children, and B, that we would pass it on to our children.